The following is a pre-recorded show. Welcome to Winning in Retirement with your host, Brian Akers, certified financial planner professional and founder of Akers Financial Group. Now, helping you win in your retirement, here's Brian Akers.
Welcome to Winning in Retirement. I'm your host, Brian Akers, certified financial planner, president and founder of Akers Financial Group. Here with me today is Alex Monk. Good morning, Alex.
Brian, great to be with you.
It is good to have you here, Monk. We have a special show. We're going to be talking about market volatility.
Okay.
And the reason we're talking about market volatility is because of this last week. We want to talk about that.
Yeah, I mean, it's a big deal, right? People have been calling.
Oh, they call because of all the emotion of what's going on, and they wonder, are they okay? And that's what we want to try to do on this show today, is talk about the approach when there is market volatility, what to think, how to handle things. And so I thought we would begin by having a special guest call in, Mark Diorio from Brookstone Capital Management. He's the Chief Investment Officer of Brookstone Capital Management and the third-party money manager that we use for many of our clients in our active portfolio management design. Mark Diorio, you out there?
I am. Thanks for having me, Brian.
I appreciate you having the time to check in with us and our people that listen to the Winning in Retirement show.
Well, definitely. We've had a pretty volatile week in the market, so maybe we want to start there.
I believe that is the answer. That's the reason we want you to hear your talk, hear your voice today. All right, Mark, so go ahead and tell us what do you think is happening in the last week to 10 days?
Well, anytime we evaluate the marketplace, we look at two components. One is a fundamental component. How's the economy doing? How are corporate profits doing? Really the underlying economic environment. And then two, we look at the technical condition of the market. So that just has to do with a little bit of how are stocks performing? What are the general trends in the marketplace and so forth and so on. So when we have an escalation in volatility, and remember that volatility is a natural part of the capital market landscape. So when we build portfolios for individuals, we take that into account. So it's not the absence of volatility that we expect. In fact, we expect volatility and bouts of volatility from time to time. So overall, the markets have had a pretty good year and probably were overdue for some type of correction. And our historical studies suggested that the August-September timeframe does have, if you look at the past election year cycles, August-September is a weaker kind of 2-month period. So we're kind of thinking that you could have a little bit of weakness in the market. But beyond that, from a fundamental perspective, the reason the market sold off or had an abrupt reaction was that there was a growth scare in the marketplace as unemployment ticked up a little bit and the fears of a recession, along with some geopolitical tensions, have risen. So that's a fundamental reason. From a technical perspective, you look at global capital flows and even currency markets, how they affect overall markets. And there we had what's called a rally in the Japanese yen, which surprised investors. And so that kind of threw off global allocation a bit. When you have unnerving moves in other markets, it can have ripple effects overall. But the key point is technical moves don't last very long. They do come into the marketplace, but they do tend to fade over time.
Now, when you're talking about the markets on the U.S. side, is there certain sectors that have had more volatility than others?
So the main area and one of the leaders in the market has been the technology sector, and in particular, a few darling type names in the tech sector that have led this market. And this is one of the areas that we thought was a little bit challenging for the marketplace, which is only a very few stocks really accounted for much of the return this year. And from a positive side, over the last 2 months or since July, maybe the last 4 weeks or so, we've seen a broadening out of the stocks actually participating or performing better relative to those darling tech stocks. And I know, having spoken with both you and Alex about overall diversification, that you guys use a pretty wide, diverse portfolio mix really to balance out any concentration risk that investors might have in their portfolio.
Yeah, many people do have a concentration list or a concentration of top 7 stocks, top 10 stocks. And I believe back when you did the semi annual market review, you're talking about how they've given most of the return came out of them. And that's just pretty amazing to see that that's what's pulling down. But they still have high price to earnings ratios compared to where average market would be.
Correct. So from a valuation perspective, those high-flying tech stocks and then really the mega cap tech stocks are not cheap, and they still haven't gotten to the area where you'd say, well, their price to earnings multiple is at the average of the market. And so why they're susceptible to sell-off is because there's an expectation that they're growing much faster than the overall market. And anytime you put a dent in that, that can cause a sell-off in those mega cap tech stocks. But on the flip side, there's been many stocks that haven't participated per se in the rally, and that's left them fairly undervalued. So really being a diversified investor, making sure you have allocations in areas that are undervalued can really offset any of that concentration risk you have in a portfolio.
All right. So when you were talking about the unemployment rate, could you just explain just what you think that does to the market and possible interest rates?
There is a signal called the SOM rule, named after the economist by the same name. It basically says after unemployment bottoms and starts to tick up, so the unemployment rate starts to tick up, once you get past a few, about 0.25% or so of a tick up or 0.5%, that has triggered a recession or has been an early warning sign for recession. And so that's what got into the marketplace a little bit, that may be occurring. Now, I think it might be a little bit of a knee-jerk reaction to that rule, because rules always work until they don't. So it's one of the indicators that we would use to evaluate the overall market. It wouldn't just be the sole indicator.
Now, recessions usually is something in the rearview mirror where you look at the markets and you say, correction's down 10%, a recession's down 20%. Is that what you're talking about when you're talking about recession in that aspect?
As far as impacting the markets, you're absolutely correct, which is a recession is generally 2 consecutive quarters of negative GDP growth, and GDP is a way to measure the overall economy. Stocks typically enter a bear market, which would be a decline of 20% or more, coincidental with a recession. And the reason they decline that much is because earnings would be declining as well during a recession, since there's less business activity. We had a non-recessionary bear market in 2022. And one of the reasons the market started to bounce back in 2023, 2024 has been that the recession never materialized and has really been pushed out and looks to be continuing to push out. That's not to say that there's not concerns and we don't have to keep a close eye on some of the incoming data when we build portfolios, but that's been the main reason. So your overall summary is correct, which is that 20% decline does coincide with an economic recession.
So when we're looking at this volatility currently, would this be just a correction, or what do you think?
At this point, we think the data lines up with a correction. The NASDAQ, which is kind of a tech-heavy index and is well known, on average, it takes about 21 days for that index to drop about 10%, enter that correction phase. A correction would be -10 to -20, and then more than -20, as we just mentioned, the bear market. This time it took 17 days. So it was pretty quick correction overall. And it takes about 2 months to work yourself through, about 43 days to work through a correction. So we don't think it's out of it or there's something that's going to materially change quickly. Sometimes the market just has to work through these issues. But if we start to see the slowing in economic growth, which I think we are definitely seeing slowing, the Fed is on alert to reduce interest rates before year end, which will ultimately loosen financial conditions, which would be supportive of asset prices and the overall economy. So we think that this is a correction in an ongoing general uptrend.
Okay, so correction and general uptrend would be pretty positive to the growth part of the market or the broad market?
the broad market, and this is a good point, where the major indexes are concentrated at a level in the top 10 stocks, the 10 largest stocks, at a level that they haven't been concentrated at in 50 years. So it's very much the traditional indexes are very concentrated, and we see a lot of the value and the potential growth over the next, not just the next year, but for even a longer period than that, coming in some of those less represented areas, because investors are underinvested in all the other areas that might benefit from a declining interest rate environment, where tech stocks kind of have already had a pretty big move, and the other area, which has left the other areas really looking pretty attractive on a go-forward basis.
So when do you think interest rates will actually drop? Is that the Federal Reserve meeting September, or just some week all of a sudden we'll wake up and they're down?
The market expects September. We would say they'd like to wait to December to get past the election, so they're not playing kind of or accused of playing politics, although they might get accused either way. So I'd say it's likely September. We're pretty comfortable, even if it happens in December. The point is that the next move in interest rates is lower, and that'll set the stage for 2025, where we see them continuing to slowly reduce interest rates.
All right, Mark. Well, we do appreciate you going through some of the market volatility recently with us. Thank you for your time, and we look forward to talking to you more in the future. And those out there listening to our radio show, it's our first quarter has been wrapping up here. Alex Monk and I are here. We just had Mark Diorio from Brookstone Capital Management. Akers Financial Group, we're a local. We're independent. We don't report to a big company on Wall Street. We report to you. We have offices in Farmville and Lutherville, and clients all around the Mid-Atlantic region, all around the country, and even a few around the world. It's so easy to begin winning in retirement. Just give us a call and schedule your meeting with one of our team of advisors. Call us at 833-WIN-RETIRE. That's 833-WINRETIRE. We'll give you a call on Monday to schedule your free in-person meeting, or you can go to akersfinancialgroup.com or call us at 833-946-7384 to start planning for your retirement now. Don't let the noise annoy you. We'll talk about this when we return.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome back to Winning in Retirement. I'm your host, Brian Akers. I'm a certified financial planner. I'm a professional. Also with me today is Alex Monk, also a certified financial planner practitioner from Akers Financial Group. And we welcome you to the second quarter of our show. This show's on market volatility, stock market volatility. And we are very blessed to have Mark Diorio cover his opinion on some things based on the last week to 10 days. And he covered that with us. And now Alex and I are going to talk about Mark and about the markets. They rhymed, Mark and the markets. So I thought we'd go that way.
I like it.
So the thing is this, Alex, I thought we'd start with the question is don't let noise annoy you. What does that mean?
Right. So let's talk about what is noise and what is normal, right? Because there's a news cycle these days, and I really wish this wasn't happening right now. It's the Olympics. Olympics are awesome, but we have to talk about the market, right?
Right.
Because it's down significantly, but historically, this happens every year. This is a normal pullback. I think the numbers you said earlier is 14, something like that.
Yeah, 14% is a high to low every year on average.
Like peak to trough. So that's just, people see these returns, we're still up for the year. So if the year ended right now, it would be a positive year.
Yeah. Well, the news, when it comes to noise, they'll say the largest point loss in history. And guess what? It was because the market's at the highest point in history. And so the percentage is nowhere near like a market crash that was in October of 87, all the different ones over the years where they had a true correction, even into a bear market, which basically means from the top at least 20% down to get to something like that.
And usually when moves happen on the downside, it's not like a gradual thing.
No, it's quick.
It's quick.
Now, Mark mentioned about 21 days average NASDAQ in a normal decline. and we've had 17 days of that. So that gives hints as it starts to move down. Dow and S&P, all those give hints on it, and then they have a couple of big days down, and then a buying day, then a sell-off day, and then a buying day. And then the thing is that volatility, the up and down, is what we got to look at and examine how that applies to your personal finances.
Right.
If you need a check on Monday from the stock market, you shouldn't be in the stock market. You should be out.
If you need to check Monday this year, you probably shouldn't have all your money in the stock market.
Absolutely, because we need to plan ahead knowing that the market's going to be volatile. There's a normal movement to the market. It doesn't always go straight up, even though that's what people would like it to do.
Yeah, well, I mean, if that's what it did, then we wouldn't. I personally, I get excited around these type of events, right? Because these are opportunities.
Yeah.
Like for us, this is a great time to add money to the market if we've been waiting to buy.
Absolutely. You can take this noise to our advantage, the noise of negativity of the fact that, certain stocks are down 20, 25, 30%, and it might be a time to buy into a diversified portfolio. Now, at Akers Financial Group, we work with Mark Diorio, designed different portfolios together, and we have made those defensive moves. We made the changing over to equal weighted and things like that. In the past, we didn't do it just recently. We didn't do it this week.
I know we were early. I mean, not late.
No, we did it pretty well. We sort of got the money diversified the way we like it. The key thing is that sometimes when you have 7 to 10 stocks take off, like has happened in the NASDAQ and the S&P 500, especially even the Dow, when that takes off on you and you see a couple stocks making all the money, you think everything's making money, and that's not really been true. The broader market is only finally making some money since some of the other profits have started to come down.
It's like some of those names, like NVIDIA is the name that like I've had people throw at me for like a year. Like if you owned a stock, like that's the one that you wanted to own.
Yeah.
And it's finally had some breathing room on the downside. It's a normal company. Like, this is part of the market. Like, we can't get caught up with excitement in those 7 names because that's going to come and go. And we're seeing that right now. And I think having this diversified setup, I don't even, like, I get excited when I see these things. I don't worry at all.
That's because you have long-term money. And so the concept is if you're building your planning and you have your cash position right, you got yourself out of high interest debt and you got yourself lined up for investing and you're investing for 3, 5 years or longer to your future, these are more about buying opportunities than something to fret over. Right. So the idea of the noise or the emotions of the market is what we need to talk about and make sure that people are understanding what's emotion, what's noise versus, is there a true issue that is going to really pull back the markets and stay down for a long time? Or is this something like, I guess Mark Diorio implied that these are corrections that then with interest rates possibly lowering the next 6 months to a year, you'll see the markets positively react to that. And that's what the Federal Reserve's been waiting for a while now, is the market to show any type of downturn, to show unemployment, to show some pain that it's not all just wonderful.
Right. Some curb to inflation, right? So some slowing or topping out of growth. And that's what they were trying to do. And when they lower interest rates, it should really change kind of the functioning of what's going to do well in those capital cycles too. Like your smaller companies that rely more on debt should do better when interest rates go down in theory. So it's another reason why you want to make sure you're not concentrated in just 7 giant companies. Because as these tides change, you can make money in a lot of different places.
Correct. And you can make it in different places. What do you mean by that?
Like different places of the market, meaning the capitalization or size of the company, right? So those mega 7, those things are huge. Well, there's a whole nother, how many other companies listed on the stock exchange? Thousands?
Yeah.
Yeah. So we got to look at some of those. Or do we have enough money international? Do we have too much money international? Like all these types of things. Events like this are a good reason to look at your portfolio too and say, hey, do I need to lift the lid on my 5 mutual funds, which might own all the same thing?
One of the things that happens is when people hear the emotions of the market, they believe it's going to be a large crash. And so the first thing they want to do is sell. So the noise and the reaction of the emotions is actually the opposite of what you're talking about. And so we really got people to think about how are they reacting to a downturn in the market? Do they see it as buying opportunities, or are they trying to sell to get out? And that's a problem, isn't it, Alex?
Well, if you're trying to sell when to get out, like if you're trying to time the market, good luck. Because Friday last week to today, it's about flat, right? But it's been crazy volatile along the way. So how do you pick the right day?
Well, the hard part, I always believe the right day to get out of the market is when you're looking at your overall portfolio, you're looking at your goals, you're looking at how money's lined up, and you look at your asset allocation and you decide that it's wrong. You're taking too much risk with your money or too little risk, and you realize it's wrong, and that's when you reallocate. Now, you might have to look at the market and see, should I trim out of what right now? Should I wait a little while? Some basic decisions, but generally, if your portfolio is too risky for you, the answer on fixing it is right now, and that would not be something you wait on because of events that can occur that you have no control over, that you really need to be diversified and take the proportionate right risk in your money.
Yeah, and I heard some talk show host this morning on the news was saying that every long-term market issue starts out and looks like a normal correction. So yes, we could be wrong, right? Like these things happen, but from what we see right now, it looks normal. So to your point, if you're taking too much risk, don't wait. Don't think you're going to recover all the way.
Yeah.
You could be completely wrong.
Well, the hardest part is that if you go back and you think about the last 5 years, there's been a lot going on. I mean, just talking about pre-COVID, and then you had COVID, and then the market volatility of COVID, just the ups and the downs immediately after COVID began, and then the recovery in certain stocks, and then the 22 down years, 23 into 24 market rising, mainly a few stocks rising, not broad. And so we sort of been waiting for things to realign. The only time we felt interest rates would ever lower is if they showed signs of some type of stress when it comes to the actual economy, unemployment rising faster, or something else triggering the point where the market could pull back. And then ultimately things that would fuel the market increase more would be a little bit less interest rates.
Right. And I think, as you said earlier, the earnings are in line in a lot of places. So it's not like earnings are aligned. What's that word? They're like normal.
Well, earnings on most companies have been pretty steady.
Right.
Is that what you mean by normal?
By normal, like your earnings to your price to earnings is what I was saying. It's a normal level. So like we're not super high in the market on valuation. We're not super low.
Unless you're tech stocks, and then they're all extremely high. And they've been extremely high and getting higher and higher. And so when you see a volatile pullback, some of it could be the argument of priced earnings, but I also argue that they don't care priced earnings on those stocks. They're excited about the idea of the stock. Oh, you're an AI? Oh, double your stock up, or whatever it might be. And then what happens is people over-concentrate in these stocks, and they believe they're going to get wealthy by betting on one horse. And the reality is wealth is accumulated over time. It's not going to be something where you try to get rich quick. You got to take your time and diversify and build your portfolio, save, let that money work for you over time. Nothing should be tried to accomplish on wealth or try to double your money in a very quick period of time. That's usually when you lose more than you make.
Yeah, and now's not the time to panic. And that's what we're telling clients. When they call, it's like, hey, we've already diversified. As you said earlier, we've made these moves. This is normal noise. This is what we are looking for.
Absolutely. Now, what we try to do at Winning in Retirement is we want the best part of your retirement to be when you get your time back, where you decide how to use it. Before retirement, your time is tied up with other commitments, mainly your job. A lot of that goes away in retirement. Your time is now consumed by things that you want to do. It's so easy to begin winning in retirement. You can go to our website, akersfinancialgroup.com, Scroll to the schedule a meeting section and let us know you'd like to schedule your free consultation with one of our team of advisors. That's AkersFinancialGroup.com, or you can call us at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We'll give you a call on Monday to schedule your free in-person meeting. You can go to AkersFinancialGroup.com or call us at 833-946-7384 to start planning for your retirement now. If a time like this happens in your retirement, will you be able to stay retired? We'll talk about this in a moment.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Indeed, welcome back to Winning in Retirement. I'm Brian Akers from Akers Financial Group. Here today with me is certified financial planner practitioner Alex Monk. We both work with Akers Financial Group, and we're here on Winning in Retirement, a radio podcast, to talk about the market, to talk about the market volatility and some of the things that we emotionally think about when we talk about the market. When we experience market movements of 1,000 points on the Dow or hundreds of points a day, you start to think about it. You got to always look at the market in a way that relates to your personal finances rather than letting the emotions of everything try to drive what might be your action or reaction. Now, what happens in the third quarter here is this. We're going to try to cover this. If a time like this, volatility, happens in your actual retirement, will you be able to stay retired? In other words, if you had a little bit of downside, would that change your financial life? What's your opinion, Alex Monk?
Well, that sounds like a trick question, right?
Trick?
It's like, yeah.
It was legit.
I mean,
I ain't trying to trick you, Alex. I'm trying to be very
well, help me with the question then, right?
Okay.
So if you retire for 30 years.
If a time like this, the volatility of the movement.
Okay.
Now, if times like this and it's your retirement, you're retired, you're home, you're not going to work tomorrow, you're relying on your money.
Okay.
Would you be able to stay retired? Now, that could go in 1,000 different directions, right? It's not just a yes or no.
I would hope so.
And why would you hope so?
Because this is normal. Like, this is going to happen.
Okay, now that you know that because of history, the market's going to be volatile up and down. So any money you have in the market during your retirement years needs to be designed to handle the up and down. It's not, you can't buy a stock and expect it to always go up. Or, I mean, of course, if you go to parties, people are going to tell you that, oh, I bought this stock, it always goes up. I always make money on it. The stocks don't do that.
No, you just can't get everyone correct 100%.
No, but the idea of stocks, diversification typically works very, very well. In the last few years in the market, if you diversified between 7 stocks, you did real well. The more diversification did not keep up with those 7. Yeah. And so the reality is when you see a pullback of the mega tech side, people that are basically saying we love diversification are actually okay with the pullback because that'll push money more broadly into other investments because of the risk level or the high P ratios in one industry or one sector that's really affecting this. So what happens is this. What do you want your money to do in retirement? That's a little different than the emotions of the market movement.
Right.
If all of your money's in the market, that's probably wrong for retirement. Right?
Well, and you should be emotional, right? Because that's a lot of risk to take.
Right. So if you're 100% in the market and you're retired, you need to look at it and question yourself.
Look at it. Like that's too much. So also what we're talking about here is sizing your overall allocation to the market. Right? Because if you're all in, you can't buy when it's down because you're already all in.
There's no dry powder or money on the side, cash or low risk money. You can move into a market when there are 10, 15, 20% downturns where you could buy.
Yeah. And so like when they talk about like time horizon and investing, what that means is your ability to not sell. Like people like, oh, I can take a risk. I don't care if it goes down, you know, this, that, or the other. But fundamentally, if you need cash, how long can you go without touching your money that's in the market?
Yeah, absolutely. So if you're listening to this show with the mindset of, I'm in retirement, I want to keep winning, well, then we're talking about that. Meaning that if you're too risky with your money, that means you most likely are not using it for income. Because our recommendation for our clients is the greater need for income, the lower the risk we take. Right. Because we want that money to be reliable, sustainable, and actually be able to beat inflation over time, which does require us to have some of it in stocks. And that makes sense.
Absolutely, right? So like, especially in an inflationary environment, stocks are the place to be.
Absolutely. Now, if you're listening to the show and you go, hey, I want to win in retirement, you should think about opportunities like this and say, okay, when a market pulls down, what can I do to help my retirement? Well, guess what? When things go down, you can do something called Roth conversions, where you can actually move from cash into the Roth and buy low, buy at a 10% discount, buy 15, whatever you're buying. If it's down, you're buying it and you're going to capture the growth back, and that'll be all tax free. So that's just a small strategy that people could do when market does correct like this.
Right. And this is also a good time to think about what's happening overall, right? Like, where's my money allocated? Mm-hmm. Like if there's a news thing that makes you check your portfolio, or something happens that makes you want to look under the hood, now would be the time to do it. Just like you said before, the time to make the changes is the second you know it's wrong.
Now, if you are listening to our show and you come in and see us, you hear us explain it on the show, and then we apply it to your financial fingerprint. So what Alex is trying to get at there is, well, what should we do? What should we do to make sense for you and your situation? Now, if you think about the market pulls back or has this volatility, and unemployment was high last week, and all of a sudden interest rates might actually go lower later this year. That means if we're on the side that's protected, we have interest rates that might be a little higher today than they will be in the next few months. Yep. So locking in a higher rate possibly into that curve of downturn. If a 5% rate on a CD drops to 4%, let's say in a year, if you're locked in 5 a little longer, that might be a good thing to do. Not going to beat inflation with that, but that's a way of having some of your extreme low risk money, your short 1-2 year money.
Right. And that's just like, part of the portfolio for sure, right? Your age minus 100 is the amount you should have in stocks and in retirement, roughly.
Yeah, that's
give or take.
Yeah, that's a nice way to start with a conversation. But then the people they come with their own baggage, right? They come in usually 100% safe or 100% in the market. There's very few barbell. Barbell is where they have extremely low risk money markets and then extremely high risk and nothing in the middle. But then there's very few really diversified properly when we first meet them.
But when they come in, they think they are, right? So they say, well, I'm moderate. Mm-hmm. And I say, okay, how? Like, show me what you mean.
Well, moderate means, I got all my money at my office, in the 401k. It's all in a target date fund. So I'm a moderate investor.
I'm a moderate investor. And then I say, okay, well, let's figure out what that means, because if you are, that's great. Like, I don't care what your risk tolerance is. I just want to make sure your money matches up with what you think you're doing.
You don't care. Is that what you just said? You don't care at all?
It doesn't matter to me. If someone's conservative or aggressive, like it's, you just...
Right, because you're trying to design what's best for them, that person.
Right.
It's not designed where here's a one size fits all. Now, it's more than just a plan. It's a constant review, talking about it annually.
I got a little fired up when you said I didn't care. I was like, wow.
I know. I was trying to get you riled up because you said you didn't care.
But like, it doesn't matter what their goals are. How do I say it? Like, I want to help them where they are, right? Whatever you want to accomplish, let's do it.
So you do care.
I do care.
That's the keyest thing. Now, when you're caring so much and you're listening to what they want, the reality is sometimes what they want is, I want it to always go up and always be the very best rate of return, and I want no downside. Yeah. So some of this becomes unrealistic. So that's a hard thing to battle when we're doing planning.
Well, and that's just about managing expectations, right? So if we're under the perception or the agreement that the market over time is going to have volatile times and go down, then we should expect it to do that and be okay when it happens, right? Or use it to our advantage, like you've been saying. Mm-hmm. So knowing that going in and really teaching clients, like, how do we use this part of our portfolio to our advantage at all times?
Well, that's a lot easier when we're not retired. So we're basically, if you're younger And getting up to retirement, you can buy more. You can adjust your 401k allocation to buy more in the broad diversified stocks and try to buy the lows. If you're retired and the money's already at work, what do you do?
Well, we do Roth conversions, or we take from safe money. Mm-hmm. We have this set up. Mm-hmm. Like in retirement, our stock money is never associated with income, only for our long-term growth numbers.
Right. I mean, we might peel some dividends off, but not much more than that, right? We don't want your next month check to be where we have to sell the stocks. One of the mistakes we'll see with some new clients, especially when they come over with a brokerage account, the brokerage account will have where they're taking their monthly withdrawal out of the market every month, and they sell a little bit of everything they own, and a check is sent. And that's sort of like a computer-driven model. It's not going to be the best use of the market timing. The market itself, right?
No, not at all, right? So the math on the downside doesn't work like the math on the upside, right?
Dollar cost averaging is great in a volatile, positive market.
Great if you're buying, bad if you're selling.
Yep. So we like to have money 6 months to a year in cash waiting for the opportunities, right?
And then the emotion, like there is no emotion. Mm-hmm. It's, that's what the market does. This is what we thought was going to happen. All right, I'm retired. Like today's what day? Is it Wednesday? Is it Tuesday? Like retired people every day's,
they can do that because they know their check's okay, right, and they know the next check's going to be okay. And that's only if the plan of diversification includes pieces that have downside protection and you have money in the market long term that can absorb some pull downs and to have time for it to cycle back up.
Absolutely. And to compete with inflation too. Like our market side is really what gives us those outsized returns in order to increase income along the years. So that balance is so important.
Yeah. So at Akers Financial Group, this is what we do, which is talking about market volatility. This is what we do for a living. So you don't have to figure it all out on your own. We help you. We love doing this, and Alex does care. I know for sure. Planning for the unexpected may not be your favorite thing to do. We know that. This is what we do. We want to make this as easy and as comfortable for you as possible, so that as we meet you and put a plan together, includes that it's going to be taken care of, planned for, and then when it happens, like market volatility, you're like, oh, we planned for that, and we're okay. Now, that might be another phone call to us and say, yes, we're okay, but you're not going to be sold something that tries to do this. You're going to be advised and planned, and we're going to figure it out together. Regardless, basically at Akers Financial Group, we want you to know that we care about you, we care about your retirement money, that it fits your financial fingerprint. It's a retirement plan based on your unique financial fingerprint that determines where your money goes. It's not about us, it's about you. So give us a call at 833-WIN-RETIRE and schedule a free in-person meeting with one of our team of advisors. That's 833-WIN-RETIRE, 833-946-7384, or visit our webpage at akersfinancialgroup.com. What do you do when people are making irrational decisions? We'll explain when we come back in a moment.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome back to Winning in Retirement. I'm Brian Akers, president and founder of Akers Financial Group. Today I have Alex Monk. Alex Monk is a financial advisor, certified financial planner. He has an accounting degree. He's been working with Akers Financial Group 13, 14 years.
Oh, yeah.
Pretty much most of your life, right?
I mean, so now I'm bald, and when I first started, I had this really funny, weird, long hair, so different world, man.
Well, what's wonderful to see everywhere you've been able to grow and mature in life. The hair might not be there, but you got a child, you got a nice boy.
Yeah, things are going good. I am very, very blessed.
Absolutely. Blessed is really about what we want people to think about their finances. Blessed is where you feel taken care of, you're comfortable. Winning in Retirement, the show is designed about the concepts of proper financial planning to get you to where you might be winning in retirement, or to actually design things so that you're winning in the retirement that you're in right now. That's what winning in retirement is. That's what we try to do this radio show about, is really about how we go about the approach of helping you win in your retirement. It's not going to be about what is the hottest product, what's the fastest way to make quick money. It's about how to handle things, how to be ready and make this money that you worked hard for last for your lifetime.
That's exactly right, Brian. We're not trying to reinvent the wheel here, right? Like, stocks are going to be volatile, so we need to size our position. We need to source our income ahead, and we need to take the unknowns out. Like, once we can take the unknowns out of your income, that's the real goal of retirement.
Yeah. So as we led into this fourth quarter, we had this topic of what do you do when people are making irrational decisions? And the idea is that Akers Financial Group, our team of advisors, we look for opportunities to actually make rational decisions. So when you're feeling irrational, you're feeling emotional, we at Akers Financial Group, having an advisor or coach, needs to be the opposite of what's going on when you're thinking about these kind of things.
Exactly. You don't want to call your advisor, right? You see markets are volatile, so you call your advisor and he's like on the top of the building, like,
yeah, you're right.
Sell everything. Like, no, like, like if that's what you're looking for, you're at the wrong spot.
Yeah, and we've seen this before. We know markets go up and down. People love it when they're going up and they get very excited. And what happens many times, and covered this in many shows in my career, but the idea is when things are going up, people get a little greedy and they believe they're going to go up forever. And so the reaction is they want to buy. In reality, that's not really probably the best time to buy. When you feel the greediest about a stock going to all go forever, if you catch yourself saying, this is the greatest stock I've ever owned, you ought to think about the opposite of, maybe I should take some trim it, maybe sell a little bit.
Well, I mean, was it 3 months ago, 2 months ago, we had the conversation when we rebalanced our portfolios to be a little bit more defensive. You know, a conversation was, I can't explain to you why the market's as high as it is right now.
Right. But let's ride as long as we can, right?
Let's trim some of these profits and let's position it to come back into a normalized range. And if I hear the word normalized on the news again when they talk about interest rates, I don't know, it's going to start losing its meaning to me. But like,
yeah,
that might be what's going on. I don't want to have to predict what the Fed's going to do to understand how to invest my money for a lifetime.
Well, like I think about people want interest rates to go back to where they were at 3%, 2%, because it was great having free money. I don't think that's realistic. I think that's also irrational, believing that that's going to head that way. I think the fact that interest rates are susceptible to how the markets do, and the Fed loves to see the economy slowing down so that it can actually lower rates. And then people that are going into debt would like lower interest rates. But those that are savers and investors don't really want lower interest rates. They like making 5-6%.
Well, if interest rates are low and things are great, what are we going to do when they're bad?
Well, that's where you have to do the other things. But the problem is we've done a lot of those things which have fed the inflation rate, really. Right. You know, sort of like governmental spending and a bunch of other things have really made this market stretch longer, made the idea of not exuberance, but whatever, there's not been a term for this market movement, but the idea is that mega caps have really gone very, very high up. And so many funds, many people have put their money in just a few things. And the reality is we do need to diversify. It's not wrong to still own some of that and have a portion, but not all your money.
Right. And naturally, if you own stocks as they run up, you're going to get some more concentration. So it's one reason to rebalance, but it's also a reason to understand where your money is.
Which most people do not know. I mean, There's some people that watch it every day, tracking it every day. They're really, really into it, but that's not the average person.
Well, that's what I'd like to do for people.
Well, you like to track it for them and take care of them. I like to think about what risks they want to have. I want them to have decisions on income and cash flow and make all these hard decisions and the day-to-day financial decisions. And then what happens is on the investment of the management of the money, how to withdraw, how to do the tax efficient planning, insurance planning, all of that would be on the financial advisory side, where we come back and say, this is how we do it. This is how we design a portfolio that's going to be more consistent, lower volatility than you might experience in any other type of setup.
Yeah, I love those commercials where they say, like, before you do anything, consult all these other different advisors. And, here we are. We're like, no, we want to be your advisor.
Yeah.
Like, we want to find out.
Well, there's some commercial that say, oh, and we also have planning as an extra. Yeah. And I'm like, well, forget that being an extra. Planning should be the lead thing.
I'm like, so the money's already invested and now you're going to work on the plan?
No, just whatever. Call. We have somebody who will tell you the answer for planning. The idea I like people to think about is this: planning makes rational decisions, helps you invest your money and diversify and spread out over time. Not every investment is going to work out perfectly. And that's the way the market is. There's going to be some stocks, some mutual funds, ETFs.
Enough, yeah, absolutely. And so, what do you say to the person that comes in with all their money safe, and they're like, "This is what I was talking about, Brian. This is why I don't want to have any money in the market."
And I say, well, what do you need your money to do? And if they say, well, I need more income, I say, well, why? Well, things cost so much money, and I just can't keep up. Once they say that the word I can't keep up, I said, I agree, because the idea of a CD-only portfolio, for years I've called CDs constantly depreciating because they don't make more interest than inflation after tax. That's something they've never been able to do, maybe in a short run.
That's so rude to say with CD rates being up. People are going to get
they're
mad.
up as good as they were 10 years ago. It took a long time to get here, so they feel incredibly good at 5. But that's not incredibly good when the inflation was 8, 7.5 back-to-back years, and you got up to 5 now. That means if you're living off interest only, it's a really sad thing. It's like if you're a CD buyer 10 years ago, you basically had no income for a decade. Right. And you can't have a portfolio designed around any one thing, because any one thing could have an issue. That's why you have to diversify what you buy, how you buy, when you buy, and build it out over time so that you can have a portfolio to last a lifetime. That's really what you're trying to work with, is how do I make my money last a lifetime, provide for the good days and the bad days, make it so that I don't have to worry about the market and make some irrational decision and say, just get me out. And you try to sell at a low, and all of a sudden you got to buy back lower, or you're just not going to be hitting the marks properly, right?
I mean, and that's like the scenario where that just scares me. Like, being on your own sounds terrifying. Yeah. Like, I really enjoy that part of, being for the volatile times is when I get to earn my keep.
Well, that's when they realize the necessity of having someone help them through when they're just like, oh, what do I do? Those kind of points, those moments in life. Well, we don't want the market to drop that far down where you get to a point like that. Like, I guess March of 2009 was one of the worst days in the last decade plus. Actually, it's more than a decade ago now. And that was where there were so many people, I can't handle any more down. I just want all of it out. And the idea is that that's really never should be a good answer. But if you ever hear yourself saying that, it might be a good buy day because of the emotions of this. Yeah. I believe people need to think about their finances. So imagine that the market's volatile. In a volatile market, is your finances okay? If you have debt and you're paying credit card interest rates like 25, 30%, don't invest in the market when it goes down. Pay off your credit card. You get a guaranteed 20, 25% savings by paying off your credit card. There's wise financial decisions to be made right now that are rational and best for you. If we were going into a recession, and in a recession, that's when people do lose jobs.
So wait a second. What you just told me is I can get a double-digit guaranteed return by paying off a credit card.
Right. Instead of paying it out the door.
Why doesn't it feel like that? Like, that's the thing that we try to change for people.
Well, it doesn't feel like it because you already bought the thing. You might have already ate it and you put it on your credit card, and all of a sudden they want to bill it. You basically have to pay for that hamburger you ate like a month ago, and now they're charging 30% more on it. People shop around a lot trying to save $1, then they charge it, and before they know it, they've paid $5 extra for the same thing.
Yeah. Well, and that's I tell people the same exact thing. I'm like, why take any risk when you're already taking a huge loss?
Yeah.
Right? Like, you're taking a 25, 26, up to 30%, I think is the cap on some of them, loss by paying that interest.
Yeah, so the idea is this. Financial planning should be the lead thing that you're doing. Within that financial plan, build out a portfolio designed to meet the income you need. If you're in those retirement years and this market volatility is hard on you, think about it. Are you relying on that money for this year's income, next year's income, or is this 5-10 years down the road? Or is this legacy money for the family, not for you? Then you can build portfolios, design and grow it. The purpose of the money dictates the risk we need to take.
Absolutely. And it's your plan that gives us that answer, right? It's your life, not mine.
Absolutely. So don't make irrational decisions when market volatility occurs. What you need to do is look for opportunities for making rational decisions. Now, we have all seen this before, and we help people plan for this volatility to happen and how to act and interact with these changes that happen in the financial markets. So we just have to be ready for them. We must change with them, and that's the only way your money's going to last a lifetime. And that's good financial planning. Thanks for going through all this today with us, Alex Monk.
As fun as it could be, Brian.
Yeah, it was a good show. We had Alex and I, and we also began the show with a little interview with Mark Diorio about the actual market volatility. If you missed any of this, go to our website at akersfinancialgroup.com and check out our radio podcast right there. We do look forward to meeting with you. We want you to win in your retirement by taking advantage of the opportunity to begin planning with one of us at Akers Financial Group. To schedule a free meeting with one of our team of advisors, go to our website at akersfinancialgroup.com. Scroll to the schedule a meeting section and let us know you'd like to schedule your free meeting. That's akersfinancialgroup.com, or you can call us at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We'll give you a call on Monday to schedule your free in-person or Zoom meeting. Go to akersfinancialgroup.com or call us 833-946-7384. Thank you for listening. I'm Brian Akers from Akers Financial Group, and we want you to be winning in retirement.
You've been listening to Winning in Retirement with your host, Brian Akers of Akers Financial Group. Akers Financial Group offers securities through Archedios Capital, an SIPC and FINRA member firm. Advisory services are provided through Archedios Wealth. Akers Financial Group and Archedios do not share any common ownership. Neither Archedios nor Akers Financial Group provides tax or legal advice. Advice given on winning in retirement is general in nature, and one should seek further advice from their financial advisor, broker, attorney, and or tax accountant before investing. Be sure to read each prospectus carefully to understand all the risks associated with each investment. Examples and scenarios shared are meant to be for illustrative purposes only. Past performance is not indicative of future results.